$14 billion forced into the market within 72 hours. Not a choice, not a prediction, a contractual obligation. While institutional banks prepare to dump massive silver positions, physical metal has vanished from dealer shelves, 2 markets, 1 metal, a collision course, paper contracts flooding the system at $78 per ounce. Yet buyers are paying $85 just to secure physical bars. And still, they cannot get delivery. What happens when the largest forced liquidation in precious metals history meets a supply shortage that defies every economic principle? Friday morning will reveal the answer. But by then, those who understand what is actually occurring will have already positioned themselves. The question is not whether this event will reshape markets. The question is, which side of this divergence will you be on when the separation becomes permanent? Welcome to Currency Forensics. For those who have built enterprises through multiple economic cycles, for those who remember when business decisions were based on fundamentals, not headlines, this channel exists for you. If you have reached a stage in life where experience has taught you that the real story always exists beneath the surface narrative, then subscribing to this channel is not about algorithms or entertainment. It is about maintaining the strategic intelligence advantage that has served you well for decades. Before we proceed with the full analysis, drop a comment below. Which region of the world are you watching from? Because what unfolds in the next 72 hours will not affect just one market or one nation. This is a global monetary event, and those paying attention from every continent will be the ones who act, while others are still trying to understand what happened. Now, let us examine exactly what is coming, and more importantly, what it means for your strategic positioning in 2026. January 9th, 2026. A date that institutional traders have marked on their calendars for weeks now, not because of economic data releases, not because of corporate earnings, but because of something far more mechanical, far more predictable, and potentially far more devastating. The Bloomberg Commodity Index, known in financial circles simply as BCOM, is facing a mandatory rebalancing requirement. This is not a suggestion. This is not a strategic decision made by fund managers analyzing market conditions. This is a contractual obligation, written into the very structure of how these index funds operate. $14 billion in precious metals positions must be liquidated, $7.1 billion in silver, $7 billion in gold, and they have exactly 5 trading days to execute the entire sale. The question every professional trader is asking is simple. What happens when this much forced selling hits the market all at once? To understand why this matters, one must first understand how index funds actually work. When silver prices rise dramatically over a calendar year, these funds find themselves holding too much silver relative to their other positions. Their allocation percentages exceed the target limits set by their investment mandates. Regulations require them to sell down to restore what they call proper balance. This is what analysts refer to as structural selling. It differs fundamentally from how most people think trading works. A normal trader looks at price charts, analyzes economic indicators, makes decisions based on what they see happening in the market. They can choose their timing, they can wait for better conditions, they can adjust their strategy. Structural selling has no such flexibility. The sale must happen, regardless of market conditions, regardless of whether prices are rising or falling, regardless of whether it triggers panic among other traders. Scotiabank, one of the major institutional banks, released an internal analysis last week. The report has been circulating quietly among professional trading desks. The numbers it contains are staggering. This forced selling represents approximately 17% of the entire open interest in March silver futures contracts. To put that in perspective, imagine 1 out of every 6 active trading positions being dumped onto the market at the same time. Not because anyone thinks silver is overvalued, not because economic fundamentals have changed, but simply because an index must rebalance its holdings. The timeline is already locked in. Selling begins after the market close on Thursday, January 8th. By the time markets open Friday morning, the impact will already be visible. Professional traders who understand these mechanics have been positioning all week. Some are preparing cash, waiting to buy what they believe will be a temporary dip in prices. Others are reducing their leveraged positions, protecting themselves against potential volatility. Many retail investors, the individuals trading from home, remain completely unaware this event is coming. The previous trading session already showed warning signs. Silver corrected from its recent high of $83 back down to $78. Some market commentators dismissed this as normal profit-taking, traders cashing out after a strong rally, but those watching the underlying structure recognized something different. They saw the beginning of positioning ahead of Friday's forced liquidation. The technical charts show silver trading within what analysts call a triangular consolidation pattern. This is typical behavior during strong bull markets, a period of sideways movement, a pause, before the next leg higher begins, Earlier in this rally, silver consolidated just above $50 per ounce. That sideways movement lasted several weeks. Then the breakout came. Silver surged from $54 all the way to $83, a move of nearly $30 in just a matter of the weeks. Now the market finds itself in another consolidation phase. But this time, the normal pattern is being interrupted by $14 billion of forced institutional selling. Every serious investor is now facing the same question. Will this massive sale be absorbed by buyers waiting on the sidelines, or will it trigger a cascading sell-off, pushing silver significantly lower? Money has been sitting idle, waiting for exactly this kind of opportunity. Investors who missed the initial rally from $30 to $80, they are hungry for entry points. But there is something most mainstream analysis is completely missing. The BCOM index does not actually hold physical silver bars sitting in vaults. It holds paper derivatives, futures contracts, exchange-traded fund shares, financial instruments that represent silver, but are not actually silver. This distinction will prove critical in the next 72 hours, because while paper contracts can be created and sold in unlimited quantities, physical silver, the actual metal itself, has become extraordinarily scarce. There is a shop in New York, and another in Los Angeles, and dozens more across North America. In these shops, people can buy silver, actual physical silver bars and coins, and there's a trading screen in Chicago where billions of dollars in silver contracts change hands every single day. For decades, these two places moved together, like dance partners following the same rhythm. When the price on the screen in Chicago dropped, the shops lowered their prices. When the trading screen showed silver rising, the physical dealers raised their prices accordingly. This relationship, this connection between paper and physical, was so reliable that nobody questioned it. Until now. January 2026 is witnessing something that should not be possible according to traditional economic theory. The two markets are separating, and the gap between them is widening every single day. On one side, there is the derivatives market, a world that exists entirely in computers and trading screens. This is where the $14 billion sale will happen. Contracts will be sold, positions will be closed, all of it happening electronically, in milliseconds. No actual silver moves in this market, no armored trucks, no vaults, no coins changing hands between real people. Just digital entries, promises on paper, contracts representing the right to silver, but rarely resulting in anyone actually taking delivery of the metal. The Bloomberg Commodity Index rebalancing will happen entirely within this paper ecosystem. 7.1 billion in silver exposure, liquidated with keystrokes. Then there's the other market, the physical market, where real silver bars and coins are bought and sold. This is where the story becomes truly fascinating. Major bullion dealers, the largest retailers in North America, are facing something they have never experienced at this scale. Their inventory is gone. One of the biggest online dealers shows page after page of silver listings, and nearly every single one carries the same notation: sold out. 100-ounce silver bars that were readily available just 3 weeks ago have vanished completely. The few products still showing as available carry a message that reveals the depth of the problem. Pre-sale, estimated shipping February 13th. February 13th, more than a month away. For a product that used to ship within 48 hours, this is not a temporary supply glitch. This is not a shipping delay. This is structural shortage manifesting in real time. But the price tells an even more remarkable story. Under normal conditions, buyers pay a small premium above the spot price to acquire physical metal. This premium typically runs 2 to 3%, covering the dealer's costs and a modest profit margin. Current premiums on $9.99 fine silver bars have exploded to nearly 9%. Buyers are paying $85 per ounce for metal that shows a spot price of $78 on the trading screens. Why would anyone pay such a premium? Because they simply cannot get the metal any other way. The physical supply does not exist at lower price points. Now, here is where Friday's potential crash creates a paradox that defies everything taught in economics textbooks. If paper silver drops 10% due to the forced selling, spot price could fall from $78 to $70. Traditional economic thinking says premiums should compress, dealers should lower their prices accordingly, but those who understand what is actually happening know the opposite is far more likely. Premiums will expand, not contract. Buyers who see $70 spot silver will rush to purchase, thinking they are getting a bargain. Dealers, with almost no inventory left, will simply raise their premiums to $15, $20, even $25 over spot. The actual cost of acquiring physical metal may barely move, even as the paper price crashes. This exact phenomenon has happened before. March 2020, when global markets panicked, paper silver briefly touched $12 per ounce on the trading screens. Yet physical dealers were charging $25 to $30. The two markets completely decoupled. Retail investors trying to buy the dip discovered something shocking. They could not actually obtain the metal. The electronic spot price became meaningless for anyone wanting real silver in their hands. Within months, mints ramped up production, refineries worked overtime, and the two markets reconnected. But January 2026 presents a critical difference. Refineries are already running at maximum capacity right now. They are melting down 90% junk silver, old pre-1965 coins, just to meet demand for pure bars. There is no spare capacity, no ability to suddenly increase production when demand surges. This creates what economists call an inelastic supply curve. No matter how much demand increases, physical supply cannot respond quickly. One segment does offer opportunity, though. Constitutional silver, those old pre-1965 US coins containing 90% silver content. These coins cannot be easily refined and delivered to commodity exchanges. They require time, energy, processing. Because of this friction, constitutional silver currently trades much closer to spot price, and dealers still have substantial inventory. For those who understand what is coming Friday, this may represent the only real opportunity to acquire physical metal if paper prices drop. But this raises a question that nobody in mainstream financial media is asking. If the paper market crashes and the physical market holds firm, what does that reveal about the true value of silver? A Russian oil tanker, sailing through international waters in the Atlantic Ocean, suddenly surrounded by United States Coast Guard vessels. January 8th, 2026, American forces board the ship, seize control, and redirect it to a U.S. port. The vessel had been carrying Venezuelan crude oil. Under traditional maritime law, under the conventions that have governed the high seas for over a century, this action constitutes something very specific, an act of aggression. Most people watching financial news saw this story and moved on to the next headline, but those who understand how systems actually work recognized something far more significant. The rules are being discarded in real time, and when rules disappear, when international agreements become meaningless, when major powers begin seizing assets without legal justification, people start looking for safety. Not safety in banks, not safety in government bonds, not safety in currencies that can be frozen with a single executive order. They look for safety in things that exist outside the system entirely. Gold cannot be seized in international waters. Silver cannot be frozen by government decree. These metals exist independent of any political structure, any legal framework, any banking system. And that independence is becoming more valuable every single day. But the tanker seizure is just one crack in a much larger structure that is beginning to fracture. The same day the ship was seized, Iran's military chief issued a public statement, a warning of potential preemptive strikes. This statement came in direct response to rhetoric from Washington regarding how Tehran treats its own citizens. Israel, simultaneously, is preparing military scenarios that were considered unthinkable just 6 months ago. War planners in Tel Aviv are running simulations, positioning assets, preparing for escalation. This pattern has repeated so many times over the past few years that most people have stopped paying attention. Rhetoric escalates. A small military event occurs, brief engagement follows, then temporary calm returns. Each cycle, the baseline level of tension ratchets slightly higher. Each cycle, the window for diplomatic resolution narrows a little more. At some point, the pattern breaks. The 12-day conflict becomes a 12-month war. The regional skirmish becomes a global realignment, and markets that thought they understood the risks discover they were pricing in the wrong scenario entirely. There is an anomaly appearing in energy markets that almost nobody is discussing. West Texas Intermediate crude oil, the benchmark for American oil prices, is trading at $56 per barrel. Silver is trading at $78 per ounce. An ounce of silver now costs more than a barrel of oil. Historically, this relationship only inverts during extreme dislocations. Either oil has crashed due to demand destruction, or silver has spiked due to monetary crisis. Current global conditions do not reflect demand destruction. Energy consumption remains robust. Industrial activity continues. Economies are still functioning. So why is oil so cheap relative to silver? Because oil is mispriced relative to what is coming. When conflicts escalate beyond the current contained level, when shipping lanes face genuine interdiction, when refinery capacity in contested regions goes offline, oil will not stay at $56. It will spike violently, and silver's current premium over crude will evaporate. Not because silver falls, but because oil catches up to reality. Meanwhile, the United States economy is showing unmistakable signs of deterioration. The national debt crossed $38.58 trillion last week. This is not a theoretical number. This represents actual obligations that must be serviced, either through tax revenue or through currency creation. Tax revenue is constrained because economic activity is slowing. November job openings data, released just days ago, showed the lowest level in over 12 months. Businesses are not hiring. Expansion is stalling. The engine that generates tax revenue is decelerating. This leaves only one option: print more currency. The Federal Reserve's own projections, visible through what traders call the CME Fed Watch tool, reveal market expectations. 2 interest rate cuts by December 2026, 50 basis points of easing, modest accommodation to support growth. But these projections are built on assumptions that no longer hold. They assume geopolitical stability that does not exist. They assume fiscal discipline that will not materialize. They assume economic resilience that is not evident in the actual data. The reality will be far more aggressive. Federal Reserve Chair Jerome Powell's term ends in May 2026. Just 4 months from now, his replacement will almost certainly prioritize political pressure over inflation concerns. The incoming administration has already stated explicitly interest rates must come down significantly, not by 50 basis points, by hundreds of basis points. This is not speculation. This is stated policy preference. When economic data continues weakening, when geopolitical events demand fiscal response, when the choice becomes recession or money printing, central banks always choose printing. They have no other option in a debt-saturated system. The Federal Reserve announced in December 2025 the resumption of Treasury purchases, quantitative easing, by another name, direct monetization of government debt. This program will expand, not contract. Markets are pricing in 2 rate cuts and modest bond purchases. They are not pricing in what is actually coming: a return to crisis-level intervention, potentially exceeding even the 2020 pandemic response. This is why silver at $78 is not expensive. It is extraordinarily cheap relative to the monetary debasement that has not yet been priced in. The $14 billion paper sale on Friday is a distraction, a short-term technical event in a long-term structural shift. There's a chart that very few people have actually looked at carefully, a chart that spans not weeks, not months, but 4 full decades. 1980, silver reached $50 per ounce, then collapsed. For the next 40 years, the metal was trapped, consolidating, moving sideways, dismissed by an entire generation of investors as a relic. In technical analysis, when a price consolidates for that long, forming what traders call a cup and handle pattern over decades, the eventual breakout is not a temporary spike. It is the beginning of a repricing that takes years to fully unfold. 2024, silver broke above that 40-year resistance. It shattered the $50 level that had held for so long. And what happened next is what separates those who understand market structure from those who simply react to daily price movements. Silver consolidated again, just above $50, for several weeks. Skeptics called it a top. They predicted a return to $30 silver. They said the rally was over. Instead, the market broke out from $54 and ran all the way to $83, nearly $30, in a compressed time frame. Now, another consolidation is forming, a triangular pattern on the daily charts, price oscillating between support and resistance, building energy for what comes next. Friday's forced liquidation will test the lower boundary of this consolidation. It may even break below temporarily. But breaks below consolidation ranges during bull markets are typically false breaks. Shakeouts, designed to remove weak hands. Before the real move begins, traders focused on the 5-day event are missing the 5-decade structure. There's another ratio worth examining, one that reveals just how early this movement actually is: the gold to silver ratio. In April 2025, this ratio stood above 100, meaning it required more than 100 ounces of silver to equal 1 ounce of gold. An extreme reading by any historical measure. As of January 2026, that ratio has collapsed to below 60, a compression of 40% in less than 9 months. This is not normal mean reversion. This is a structural shift in relative value. If the ratio continues falling toward historical norms of 15 to 1, silver has exponentially more room to run than gold. Not because gold is weak, but because silver is reclaiming something it lost decades ago: its role as money. But even these technical patterns pale in comparison to one fundamental analysis: the M2 money supply, the measure of total currency and liquid assets in the U.S. economy. When compared to the price of silver, a ratio emerges. In 1980, when silver hit $50, that ratio reached a certain level, a level that represented peak fear, peak demand for protection against currency collapse. In 2011, when silver again approached 50, the M2 money supply had grown substantially, yet silver only matched its 1980 nominal high. It never came close to matching the inflation-adjusted or money supply-adjusted peak. To reach the 2011 ratio today would require silver above $100. To reach the 1980 ratio would require silver above $700. These are not predictions. These are mathematical calculations based on the amount of currency created since those previous peaks. Silver at $78 has not even begun to price in the monetary expansion that has already occurred, let alone the expansion that is coming. The Federal Reserve balance sheet will grow. Government deficits will widen. Debt servicing costs will consume larger portions of tax revenue. The only solution within the current system is more currency creation. This is not a political statement. This is not a preference. This is mathematical inevitability. When the choice is between defaulting on obligations or printing currency to meet those obligations, governments always choose printing. They have throughout history. They will continue into the future. There's a key distinction that separates those who succeed in precious metals from those who fail. Failed investors trade price movements. They buy when momentum is strong. They sell when volatility increases. They are perpetually shaken out at precisely the wrong moments. Successful investors accumulate physical assets. They understand that ounces matter more than dollars. They recognize that a correction to $78 is fundamentally different than a correction from $78. Just months ago, $78 silver seemed impossible. Now it is the correction level, the support zone, the price that triggers buying interest rather than panic. This psychological shift indicates a regime change in how markets perceive value. Business leaders watching these markets must ask themselves one strategic question, not whether to own precious metals, but whether they own enough. The global monetary system is not reforming. It is not stabilizing. It is accelerating toward a crisis that will make 2008 look like preparation. Silver at any price below $100 is cheap. Silver at any price below the inflation-adjusted 1980 high is extraordinarily cheap. Silver, at current prices, with physical shortages already emerging, may represent the opportunity that defines a generation. Friday's forced liquidation is noise. The 40-year breakout is signal. Those who can distinguish between the two will position themselves accordingly. Those who cannot will spend the next decade explaining why they traded ounces for dollars. Just as those dollars lost their remaining credibility, the countdown to Friday continues. But Friday is not the crisis. Friday is simply the moment when the difference between paper and physical becomes impossible to ignore. For those paying attention, the real decision was never about Friday. It was about understanding which market reveals truth, and which market is simply marking time until the inevitable separation becomes permanent